The late-year shock no one was supposed to see. They didn't move early, they didn't act when markets were busy, liquid, and alert. The shift came when attention was lowest, when desks were thinning out, and when most participants assumed the year was already finished. At the quietest point on the calendar, prices suddenly gave way. Silver, which had been trading comfortably higher only days earlier, slid sharply in a matter of hours. What looked like stability dissolved quickly, erasing recent gains and catching traders off guard. For anyone watching in real time, it felt abrupt, almost surgical in its timing. This wasn't random and it wasn't emotional, it was procedural. What unfolded was not a judgment on silver's future, nor a signal that the broader thesis had failed. It was a liquidity-driven event tied directly to the calendar, and those events tend to look dramatic precisely because they are temporary. Why timing matters more than headlines. Market moves don't exist in a vacuum. When prices shift during high-volume sessions, the reasons are often debated endlessly: sentiment, data, news, psychology. But when sharp declines occur during thin trading windows, the explanation is usually simpler and far less ideological. Late December is one of the least liquid periods of the year. Institutional participation drops, trading desks reduce exposure, volumes shrink. In that environment, even modest selling pressure can create outsized price moves. That's exactly what happened here. The decline wasn't driven by a sudden collapse in demand for silver, nor by a surprise surge in supply. It was driven by balance sheet mechanics, rules that large financial institutions must follow regardless of market outlook. The year-end balance sheet reality. Every major bank and financial institution operates under regulatory frameworks that assess risk at specific moments in time. One of the most important of those moments is the final day of the year. On December 31, balance sheets are effectively frozen and reviewed. Asset exposure, leverage, volatility, and liquidity all factor into regulatory requirements for the coming year. Assets that increase perceived risk make those requirements more burdensome. Cash, on the other hand, reduces them. So institutions do what the rules incentivize. They reduce exposure to assets that fluctuate in value and increase their cash positions, even if only briefly. Metals, equities, bonds, and derivatives can all be trimmed, not because they are unwanted long-term, but because holding them on that specific date carries a regulatory cost. This process happens every year. What changes is the market's sensitivity to it. Why the move looked so violent. In normal conditions, widespread selling would be absorbed gradually by buyers. In late December, that absorption capacity is reduced. Fewer participants are active, and many algorithms are operating with limited liquidity buffers. As a result, price declines accelerate. Stops are triggered. Momentum strategies reverse. Algorithms amplify the move. What begins as a mechanical adjustment quickly snowballs into a sharp price drop despite the absence of new information. This is why year-end moves often feel disconnected from reality. They are not reflections of consensus views. They are reflections of temporary constraints. Gold confirms the bigger picture. Silver rarely moves alone. When gold declines at the same time, the signal becomes clearer. Gold also sold off during this period, reinforcing the idea that the move was macro-driven rather than metal-specific. Silver, being more volatile and thinner than gold, naturally reacted more aggressively. This relationship is well established. When gold shifts modestly, silver often magnifies that move. The result is sharper declines and sharper rebounds. The synchronized movement between the two metals point away from fundamental weakness and toward a liquidity squeeze. The dollar's temporary strength. When institutions sell assets to raise cash, they are not expressing confidence in fiat currency. They are meeting short-term obligations. That process temporarily increases demand for dollars. As the dollar strengthens, dollar-denominated assets face pressure. Commodities, metals, and risk assets tend to move inversely to the dollar in these conditions. But this dynamic is not sustainable. Dollar shortages invite responses from central banks. Repo facilities, funding operations, and liquidity injections are designed specifically to prevent these squeezes from becoming systemic problems. Once liquidity returns, the dollar eases and assets reprice accordingly. Chart damage versus market reality. From a technical perspective, the decline did real damage. Short-term trends were broken, momentum indicators rolled over, traders who rely solely on price action were forced out. Support levels came into focus quickly. Areas that once acted as resistance are now being tested as potential floors. This is uncomfortable, but not unusual. Markets often revisit breakout zones before continuing higher. These pullbacks test conviction and flush out weak positioning. They also create opportunities for participants who were previously sidelined. Technical weakness does not automatically imply structural failure. Emotional impact and investor psychology. Sharp declines late in the year are especially draining. They occur when people are tired, distracted, and mentally transitioning away from markets. That timing amplifies emotional responses. Regret sets in, doubt creeps up, the temptation to act, to do something becomes strong. But markets are not designed to reward emotional timing. They reward patience, discipline, and perspective. If you did not sell, nothing tangible changed. The ounces didn't disappear. The long-term drivers didn't reverse. Only the quoted price moved. Price movement does not equal value change. This distinction is critical. Price is what trades in the moment. Value is what persists over time. Liquidity events distort price, but they rarely alter value. The factors that underpin silver's long-term outlook remain intact: rising industrial demand, constrained supply growth, monetary instability, and increasing debt burdens. None of these shifted during the sell-off. Markets often overreact in the short term. They rarely misprice value indefinitely. The physical market tells the truth. One of the most revealing signals during paper market sell-offs is what happens outside the screen. Despite the decline in spot prices, physical silver premiums remained firm. Dealers did not rush to discount inventory. In many cases, retail prices barely moved. This disconnect speaks volumes. When physical supply is plentiful and demand is weak, premiums collapse quickly. That did not happen here. Instead, the physical market signaled confidence that lower prices would not last. Paper selling does not automatically translate into physical liquidation. Why physical holders aren't panicking. Most physical holders are not trading on short-term charts. They are not leveraged. They are not forced to act by margin calls. They understand the difference between volatility and risk. As a result, they are far less likely to sell into weakness, especially weakness that appears artificial or calendar-driven. This creates an underlying stability that paper markets often ignore. Industrial demand creates a floor. Silver is not just a monetary metal, it is an industrial input with few substitutes. When prices fall, manufacturers benefit. Lower input costs improve margins and encourage procurement. Large buyers do not hesitate when value presents itself. This dynamic acts as a natural stabilizer. Below certain levels, silver becomes too attractive to ignore. Metal moves from financial hands into industrial use, where it is consumed and removed from future supply. That dynamic quietly supports the market during downturns. The role of short selling. Sharp declines often coincide with an increase in short positions. Traders betting on lower prices add pressure in the moment, but they also create future demand. Every short position represents a future buyer. When sentiment shifts or prices stabilize, those positions must be closed. That process can accelerate rebounds and increase volatility to the upside. What looks like weakness today can become fuel tomorrow. January changes the equation. The calendar matters. As the new year begins, the forces that drove late December selling fade. Balance sheet constraints reset. Regulatory snapshots are done. Tax-driven selling ends. At the same time, new capital entered the market. Pension contributions resume. Funds rebalance. Allocations are deployed. Liquidity improves. This shift often produces rapid reversals in assets that were pressured into year-end. Tax loss selling and forced exits. Not all year-end selling is strategic. Some of it is purely administrative. Funds sell losing positions to offset gains elsewhere. This selling has nothing to do with outlook or conviction. It is a tax calculation. Once the year changes, that motivation disappears. In many cases, positions are re-established shortly thereafter. This pattern contributes to December weakness and January strength. Nothing fundamental broke. It's important to separate noise from signal. Debt levels remain elevated. Monetary systems remain strained. Geopolitical uncertainty persists. Industrial demand continues to grow. None of these realities changed because silver's price dipped during thin trading. Markets often overreact in the short term. They rarely miss price value indefinitely. Policy constraints and the bigger picture. Tight financial conditions are difficult to sustain in a heavily indebted system. Eventually, pressure builds. When it does, policymakers respond. Liquidity returns. Rates stabilize or fall. Real assets benefit. Silver does not require perfect conditions to perform. It thrives in environments of uncertainty, whether inflationary or deflationary. Stability is the real obstacle, and stability is scarce. Perspective over panic. The late-year sell-off was mechanical, temporary, and exaggerated by timing. It was not a verdict on silver's future. Price moved because liquidity did, not because value disappeared. These moments are designed to test conviction. They also reset opportunity. A lower price with unchanged fundamentals is not a failure. It is an invitation. Markets rarely end the year quietly. When they do move, the reasons are often procedural rather than predictive. The structure supporting silver remains intact. The forces driving long-term demand are still in place. What looked like a breakdown was a reset. The pressure was released, not resolved. And when liquidity returns, the story continues. Like and subscribe this channel.